The biggest 401k mistake is not choosing the wrong fund or missing one perfect investment. It is assuming that enrolling in the account means the retirement plan is finished. Automatic enrollment is useful because it gets employees started, but it often begins with a default contribution rate, a default investment, and no connection to the employee's actual retirement goal. Someone may contribute 3% for 15 years, simply because 3% was selected during onboarding. Another employee may remain invested in the default fund without ever checking the risk level, fees, or whether the target retirement year still makes sense. The account continues operating, so everything appears to be working. Money enters through payroll, the balance changes, statements arrive. But activity is not the same as strategy. A real retirement plan should answer several questions. How much income will be needed? How much should be contributed each year? Is the employer match being captured? Does the investment allocation match the timeline? Are traditional and Roth contributions being used intentionally? Have fees, beneficiaries, and old retirement accounts been reviewed? Automation should handle repetitive behavior, such as payroll contributions and rebalancing. It should not replace decision-making. The most effective approach is to automate the saving and periodically audit the strategy. And the first part of that audit should be extremely simple. Before worrying about advanced tax strategies or fund selection, confirm that you are not leaving part of your compensation with the employer. That means understanding the full employer match.
An employer match is a part of the employee's compensation package, but many workers never collect the full amount available to them. The reason is usually not complicated. They do not know the formula. Consider a hypothetical plan that matches 100% of employee contributions up to 5% of salary. An employee contributing 3% receives a 3% match, but the remaining 2% is not automatically added. To receive the full employer contribution, the employee must contribute the full 5% required by the formula. Matching rules vary widely. Some employers match dollar for dollar. Others contribute 50 cents for each dollar. Some formulas have multiple levels, and some employers make a fixed contribution even when the employee contributes nothing. Vesting also matters. The money may appear in the account but remain partially unvested until the employee completes a required period of service. There is another less obvious mistake. Some employees reach the annual contribution limit too early in the year. If the employer calculates matching contributions pay period by pay period and does not provide a year-end true-up, the employee may miss matching contributions during the final pay periods. The solution is not to guess. Review the match formula, vesting schedule, pay period requirements, and true-up policy. Then set the contribution rate around the actual plan rules. Capturing the match is an important beginning, but it is still only the minimum. The next mistake happens when employees reach that minimum and then remain at the same contribution rate for the rest of their careers.
A default contribution rate is designed to encourage participation. It is not designed to calculate how much a specific person must save for retirement. Suppose an employee begins at a 3% contribution rate. Over time, salary increases. Debt may be repaid. Financial responsibilities may change. But if the contribution percentage never increases, the employee may continue saving far below the amount required to support the desired retirement lifestyle. This problem is easy to miss because the dollar contribution still rises when salary rises. 3% of a larger paycheck is more money, but the savings rate remains exactly the same. A practical solution is contribution escalation. The employee may increase the rate by 1 percentage point each year, direct part of every raise toward the account, or activate an automatic annual increase if the plan offers one. The correct destination is different for every household. Someone managing high-interest debt or building an emergency reserve may need a slower increase. Someone with stable cash flow and a late start may need a more aggressive savings plan. The useful measurement is the total savings rate. That includes the employee contribution plus any employer contribution. But employer money should not become an excuse to stop evaluating personal savings. The contribution rate should be connected to the retirement goal, not the number selected during the employee's first week at the company. And in 2026, employees have more contribution capacity than before. Understanding the current limits is especially important for workers who are trying to accelerate savings later in their careers. For 2026, the regular employee elective deferral limit for most 401k plans is $24,500. That limit applies to the employee's traditional and Roth 401k contributions combined. It is not $24,500 for each account type. An eligible participant who is age 50 or older may generally make an additional catch-up contribution of $8,000, assuming the plan permits catch-up contributions. That can raise the potential employee contribution total to $32,500. Participants who are age 60, 61, 62, or 63 during 2026 may qualify for the larger catch-up contribution of $11,250. Combined with the regular limit, that creates a potential employee total of $35,750. These are employee deferral limits. Employer matching and profit-sharing contributions generally do not reduce the regular $24,500 employee limit, although separate overall plan limits still apply. The existence of a legal limit does not mean every employee should automatically contribute the maximum. Cash flow, debt, emergency savings, insurance needs, and other financial priorities still matter, but employees should at least know the available capacity. Someone trying to catch up at age 62 should not assume the general age 50 catch-up is the largest amount available. There's also an important new complication for some higher earners. Beginning in 2026, the catch-up contribution may have to be made on a Roth basis rather than a pre-tax basis, and the rule depends on prior year wages, not simply the employee's current tax bracket. The new Roth catch-up rule is one of the most important 401k changes affecting higher earners in 2026. The first question is whether the participant is eligible to make catch-up contributions. Generally, that means the person has reached the applicable catch-up age and is contributing enough to use the catch-up provision. The second question looks backward. Did the participant receive more than $150,000 in wages during 2025 from the employer sponsoring the retirement plan? When the rule applies, catch-up contributions in 2026 generally must be made as Roth contributions. That means the catch-up amount is contributed after tax, rather than reducing current taxable income. Several details are easy to misunderstand. The threshold is based on prior year wages from the plan sponsoring employer. It is not based on total household income. It is not necessarily based on investment income, a spouse's salary, or income received from an unrelated employer. The rule applies to the catch-up portion. It does not automatically force all regular employee deferrals to become Roth contributions. Implementation also depends on the plan documents and payroll system. Employees affected by the rules should review their elections early rather than waiting until the final paychecks of the year. Otherwise, they may discover that payroll cannot process the contribution in the way they expected. This change also exposes a broader mistake. Many workers choose between traditional and Roth contributions using a slogan such as "Roth is always better" or "Take the deduction now." The correct decision requires a lifetime tax strategy, not a one-line rule. Traditional and Roth 401k contributions create different tax timelines. A traditional contribution may reduce current taxable income. The money then grows tax-deferred, and withdrawals are generally taxable during retirement. A Roth contribution is made after tax. The account also grows tax-deferred, but qualified withdrawals may be tax-free. The correct choice depends partly on the difference between the tax rate paid today and the tax rate expected when the money is withdrawn. Someone currently in a relatively high marginal tax bracket may value the traditional deduction. Someone in an unusually low income year may find Roth contributions more attractive. But future tax rates are uncertain. Retirement income may come from Social Security, pensions, taxable investments, required distributions, business income, and other sources. A retiree may also face several tax brackets over the course of retirement rather than one permanent rate. That is why tax diversification can be useful. Holding both traditional and Roth balances creates options. The retiree may withdraw from different account types to manage taxable income, Medicare-related costs, or large one-time expenses. The mistake is treating the decision as ideological. Traditional is not automatically smarter because it creates a deduction today. Roth is not automatically smarter because the word tax-free sounds attractive. The question is when paying the tax is likely to be most efficient. After choosing the tax wrapper, the account still needs an investment strategy, and one of the most damaging investment mistakes is holding a portfolio whose risk has no relationship to the employee's real timeline or financial capacity. A 401k can fail in two opposite directions. The account can take too little risk or far too much. Some employees leave most of the balance in cash, a money market option, or a stable value fund for decades. The account may experience limited short-term volatility, but the investor accepts the risk that growth will not keep pace with inflation and future retirement spending. Other employees hold almost everything in stocks, even when retirement is approaching and the account may soon be used for withdrawals. That allocation may offer greater long-term growth potential, but it can also create severe losses at the exact moment the investor needs stability. A third employee may become too conservative too early. A heavy bond allocation 30 years before retirement can reduce volatility, but it may also increase the risk of insufficient growth and outliving the portfolio. Age is relevant, but it is not the only variable. The correct allocation should also consider job stability, emergency reserves, pension income, Social Security expectations, other investments, health needs, and the flexibility of the retirement date. Risk tolerance describes the investor's emotional willingness to accept volatility. Risk capacity describes the financial ability to survive losses. The portfolio should respect both. Changing the allocation after every market headline usually makes the problem worse. The goal is to choose a risk level that can be maintained through different market environments. Many plans attempt to simplify this decision using target date funds, but target date funds create their own mistakes when employees choose the wrong year, combine multiple funds, or add investments without understanding the overlap. A target date fund is designed to provide a diversified portfolio that gradually becomes more conservative as the target year approaches. For many employees, it can be a practical all-in-one solution, but the year in the fund's name is only a starting point. The first mistake is selecting the wrong target year. Someone planning to retire around 2060 but holding a 2040 fund may be invested more conservatively than intended. The opposite mistake can create more risk than the investor can tolerate. The second mistake is combining several target date funds. Owning a 2045, 2055, and 2065 fund does not create better diversification. It creates overlapping portfolios with different glide paths and no clear overall strategy. The third mistake is adding other funds without evaluating the result. A target date fund may already hold U.S. stocks, international stocks, and bonds. Adding an S&P 500 fund or another bond fund changes the asset allocation and may create unintended concentration. Investors should also understand whether the glide path is designed to reach its most conservative point at the target date or continue changing through retirement. Funds with the same year can have different fees, stock allocations, bond exposure, and risk levels. A target date fund can function as the entire retirement portfolio. Adding more funds does not automatically improve it. Sometimes it simply makes the account harder to understand. At this point, we have already covered several mistakes that happen quietly over many years. Before moving into fees and concentration risk, this is the right moment to support a channel built around preventing exactly those slow, expensive errors. If you prefer retirement investing without shortcuts, panic-driven market predictions, or claims that one fund can solve every financial problem, subscribe to Boring Money Wins. The purpose of this channel is to explain the decisions that quietly shape long-term results. That includes employer matching, contribution rates, traditional versus Roth elections, asset allocation, fees, rollovers, bonds, ETFs, and retirement income planning. Most costly retirement mistakes are not dramatic. They happen through a small contribution rate that never increases, a fee that is never reviewed, an old account that is forgotten, or a portfolio that remains on autopilot long after the investor's life has changed. If this video is helping you identify weaknesses in your own 401k, click the like button. That helps YouTube recommend it to more employees who may be contributing regularly but have never completed a full retirement account audit. Automation is valuable. Neglect is not. Now, let's continue with one of the easiest mistakes to underestimate. A fee of 1% may appear insignificant on one statement, but it is not paid once. It is reduced the amount remaining invested year after year, which means it can also reduce the future growth that money might have produced. A 401k can contain several different types of fees. Investment fees include expense ratios and management costs charged inside mutual funds, collective investment trusts, and other plan options. Administrative fees may cover record keeping, accounting, legal services, websites, statements, and participant communications. Individual service fees may apply when someone takes a loan, uses a brokerage window, requests a distribution, or uses another optional plan feature. These expenses may appear small because they are usually expressed as percentages or deducted quietly from the account, but the relevant measurement is the net return. That is the investment's gross return minus every fee paid along the way. A 1% annual fee is not a 1% one-time cost. It is charged repeatedly, and the money used to pay it is no longer available to compound. This does not mean the cheapest fund is always the best fund. A slightly more expensive option may provide a useful strategy, stronger diversification, or services that justify the cost. But investors should know what they are paying and why. Review the plan's fee disclosure. Compare expense ratios among funds with similar objectives. Check whether the employer pays administrative expenses or passes them to participants. Examine the costs of any brokerage window. Fees matter most when they provide little or no corresponding value. Another risk can be even more concentrated. Some employees depend on one company for their salary, benefits, career, and a large portion of their retirement account. That creates far more exposure to the employer than they may realize. Employer stock can feel familiar. Employees see the company's products, understand the industry, and may believe they possess special insight into its future. The employer may also provide shares through matching contributions, stock awards, or an employee purchase program. But familiarity does not eliminate concentration risk. An employee's financial life is already connected to the company. The employer provides salary, health benefits, career progression, and possibly future bonuses or equity compensation. If the 401k also contains a large employer stock position, one corporate crisis can damage several parts of the financial plan simultaneously. The stock may fall, the company may reduce bonuses, layoffs may occur, and the employee may be forced to search for a new job during the same period the retirement account is declining. A diversified portfolio spreads exposure across many companies, industries, and sources of return. Employer stock concentrates those risks in one management team and one business model. This does not mean every employee must immediately sell every share. Tax rules, plan restrictions, holding requirements, and personal circumstances may affect the decision. The first step is measuring the complete exposure. Include employer stock inside the 401k, restricted shares, stock options, and holdings in taxable accounts. Then ask whether a severe decline would damage both current income and long-term savings. Concentration can grow unintentionally during strong performance. That is why it should be reviewed rather than ignored. But company stock is not the only way employees weaken the future account. Many also remove money early through loans and hardship withdrawals without calculating the complete cost. A 401k loan is often described as borrowing from yourself. That phrase makes the transaction sound cost-free. It is not. A plan loan is generally limited to the lesser of 50% of the vested account balance or $50,000, although specific rules and exceptions may apply. The loan is normally repaid through payroll, often within 5 years, unless it is used for a qualifying primary residence. The interest is credited back to the account, but the borrowed money may no longer be invested in the original portfolio. If markets rise while the money is outside the investments, the participant may miss part of that growth. Loan payments also reduce current cash flow. A job change can create additional complications, and an unpaid balance may eventually be treated as a taxable distribution. A hardship withdrawal is more permanent. The money leaves the retirement account and generally cannot be repaid to restore the same contribution space. Income tax may apply, and an additional 10% tax may apply when no exception is available. The larger cost is loss compounding. $10,000 removed today is not only $10,000 missing from the account, it is also the future growth that money might have generated. Sometimes accessing the account may still be the least harmful available option. The correct approach is to compare alternatives, understand the plan rules, and calculate the retirement impact before acting. A similar need for caution appears when changing jobs, because one careless rollover decision can turn retirement savings into a taxable distribution. Leaving a job creates several possible paths for the old 401k. The money may remain in the former employer's plan, assuming the balance and plan rules permitted. It may be moved into the new employer's plan if that plan accepts rollovers. It may be transferred through a direct rollover into an IRA, or it may be distributed to the employee. The last option can be extremely expensive. A cash distribution may become taxable income, and an additional 10% tax may apply when the employee is below the applicable age and no exception is available. The money also stops compounding inside the retirement account. The safest rollover process is often a direct transfer from the old plan to the receiving retirement account. When completed correctly, the participant generally avoids the mandatory 20% federal withholding that applies when an eligible rollover distribution is paid directly to the employee. With an indirect rollover, the participant generally has 60 days to deposit the eligible amount into another retirement account. Because 20% may be withheld, the employee may need to replace that amount using other money to complete a full rollover. Failing to meet the deadline or replace the withheld amount can create a taxable distribution. But a rollover is not automatically better than keeping the old plan. Compare fees, investment choices, creditor protection, withdrawal options, services, and convenience. A job change is an administrative event. It should not become an unplanned abandonment of the retirement strategy. With all these mistakes identified, the final step is building a simple annual audit that prevents small problems from remaining invisible for decades. A useful 401k audit can be completed using 7 questions. First, are you contributing enough to capture the full employer match available under the plan's formula? Second, has the contribution rate increased as income and financial capacity have grown? Third, are traditional, Roth, or split contributions being used as part of a deliberate lifetime tax strategy? Fourth, does the asset allocation match the retirement timeline, risk capacity, and other household investments? Fifth, what are the complete investment, administrative, and individual service fees? Sixth, are the beneficiary designations current? Beneficiary forms should be reviewed after marriage, divorce, births, deaths, and other major family changes. Seventh, are old employer plans and rollover accounts still serving a clear purpose? This audit should be completed at least once each year and after major changes such as a new job, pay raise, marriage, divorce, new child, or approaching retirement. The final principle is simple. Automate the saving, audit the strategy, capture the available match, increase contributions intentionally, control fees and concentration, avoid unnecessary withdrawals, and never assume the default settings understand your financial life better than you do. The biggest 401k mistake is believing the account will manage itself. A strong 401k does not require constant trading or endless complexity. It requires a clear plan, consistent contributions, diversified investments, and occasional maintenance. That may sound boring, but over a full career, boring decisions repeated correctly can produce very powerful results. And that is how boring money wins.